From the newsrooms of the Sydney Morning Herald and The Age, this is Inside Politics from Please Explain. I'm Stephanie Peatling, in for Jackie Maley. It's Friday, the 21st of April. Yesterday, a long-awaited review into the Reserve Bank of Australia was unveiled.
The Reserve Bank is set for its biggest shake-up in decades, with the Treasurer giving his in-principle backing to 51 recommendations to reshape the body. It comes in the face of strong...
The 51 recommendations, including the creation of a new interest rate setting board, represent the biggest shake-up to the RBA in more than 60 years. So what exactly has the report recommended? And, if implemented, how might those recommendations change Australia's economy in the future? Today, Senior Economics correspondent Shane Wright joins me to discuss the review and what it might mean. Before we get into the RBA review and its recommendations, I'd like to step back for a moment. Can you remind us of why this review was commissioned in the first place and what led up to it?
Let's go back a little bit in time to the days before anyone knew what COVID was. And at that time, the Reserve Bank was under a bit of pressure in really niche economic circles that it had kept interest rates too high in the run-up to 2019. About 2 years later, these mastheads, we ran a very large series all about the debate going on that the Reserve Bank, which hadn't seen a review since the early 1980s, was a bit behind the ball when it came to its interest rate settings and how it was dealing with issues compared to every other central bank in the developed world. Then you get into COVID and the central bank takes interest rates to a record low, engages in what we call quantitative easing that no one understands, and there's some people at the Reserve Bank who may not understand. And that includes, very famously, Phil Lowe saying, look, we don't think we're going to have an inflation problem that will require higher interest rates until 2024. He made those comments right up until the end of 2021. And so as soon as he started lifting rates in May 2022, you can see there's a lot of people politically and in the suburbs of this country who have taken on record levels of debt, who've got angrier and angrier at Phil Lowe and the Reserve Bank for every interest rate rise that we've seen between May last year up until including March this year.
So let's step through the key recommendations. Perhaps one of the most interesting is the recommendation to create a new interest rate setting board dominated by economic experts. Can you tell us about that and why has the report suggested that?
The reason the review's recommended that is that that's where all other central banks are, because the review goes into this in a great depth, is that setting monetary policy is not just a tick and flick, oh, we've got interest rates at this point, what will they need to be next month? It is a very difficult juggling piece that requires a deep understanding of how the economy works. As we saw through COVID, it's not just about setting interest rates. The Reserve Bank created $400 billion, maybe 20% of GDP, to try and get the economy through COVID. That is a huge change, a huge decision to make, and you have to understand what that means. So to step back, the board we have is something that Red Ted Theodore, the treasurer to Jim Scullin in the Great Depression in 1930, came up with this idea of a board made up of ordinary people who should understand how the economy works. It got knocked back, but it was resurfaced when the bank was formally created back in 1959, 1960, and that's what we've had. They are expert amateurs is a good description of the board members. And especially the last 10 years, all of them have come out of the business community. So you get to this point, okay, we've got really good business people, but do they understand macroeconomics? Do they understand monetary policy? Do they understand the connection between them? Do they understand what's going on in the labour market? Do they understand what's going on in the wages sector? And the review, by recommending this, is saying, no, they don't. We need a change to move towards these more expert opinions. So that's at the top of the list of the most important recommendations. Then you get to really big ones as well. Don't meet as often. So that's another idea we can go to. There's another key part of this, and that's this new monetary policy committee. Every member of it is going to be expected to speak publicly and talk about what they're thinking. this is a real chance to put pressure on the government of the day, saying, look, fiscal policy is a bit loose at the moment. You could see a bit more criticism coming out of the bank directed at the government of the day, which at the moment the Reserve Bank doesn't really directly criticises the government. I think down the track you could see that coming through.
I think one of the things that a lot of people will be interested in is the suggestion that there should be fewer board meetings, which would mean that there would be fewer opportunities during the year for the board or the new committee, as we're now going to be referring to it, to change interest rates, which obviously affects people's payments on their mortgages. What's that all about? Is it to give people more breathing room, or is it to give the bank more kind of control about what these settings mean when they flow through to the economy?
There's a bit of both in that. Like at the moment, the Reserve Bank's about the only bank in the world, apart from the Bank of New Zealand, that meets every month. So there's a really good example. The Bank of England used to do monthly meetings, and then they moved to meeting every 8 weeks. And the theory is, and this is why it's practiced overseas, is that not that much happens every 4 weeks for a central bank to think, oh, we've got to reset monetary policy. And there's a danger of, and this is where the Bank of England ended up, there's a danger of over-interpreting a really small set of data and then making a decision. So the theory is, right, if you take just a little bit of more time, you'll have a bit more information. And we're actually seeing that play out at the moment. The Reserve Bank made a decision earlier this month not to lift interest rates, but the data since then suggests they probably should have. And that's they got caught in having a meeting every month. So that's the advantage for the central bank. So it gets a bit more time to take in what's going along. For consumers, 10 of the last 11 months, interest rates have gone up. So in this way, as a mortgage holder, you probably get a bit more time to absorb whatever the bank does to you. There's no clear evidence whether it means bigger interest rate rises or bigger cuts, depending on where we are in the cycle, in the economic cycle. So there's no sign that that amplifies it, but there would be a chance of bigger cuts or increases because they have fewer opportunities to move interest rates.
There's also a push for the governor to do more press conferences, which would mean, I suppose, that he would become in some ways more publicly accountable for the decisions around interest rates in particular. Governor Phil Lowe today at his press conference didn't seem super keen on that idea, I think it's fair to say. But why has that been such a big focus of the review?
Well, Phil Lowe is unusual by central bankers because until COVID, he'd never done a press conference. There's been, I think it's 4 press conferences now by the governor. And before that, none of his predecessors had done press conferences. Like this has been a recent development by Lowe trying to communicate. And this is what it comes down to. It's the communication aspect. So you and I both have mortgages. We want to have some idea of what's in the mind of the people who are going to decide whether we're going to pay more or less. One of the criticisms has been the bank's communication has been more focused at economists and financial markets, not ordinary punters like you and I. And this is the idea. Having a regular press conference, so Jerome Powell, who's the head of the Federal Reserve, for instance, he fronts up after every decision meeting, committee meeting, to do a full press conference. So journalists can actually tease out what's the central bank thinking, and that's part of it. If you have 8 meetings rather than 11 meetings a year, then you're getting a chance for the Reserve Bank governor to really explain in depth what they're thinking, rather than at the moment we rely really heavily on the governor doing a speech. So you can't get that free roaming discussion which might really tease out what the governor's thinking through questioning. And it's really difficult to get questions up to the Reserve Bank governor as someone who tries quite often.
Were there any recommendations that you were surprised to see? Were there any recommendations that have been met with concern?
It's only early, but there hasn't been many with concern. One of the extent at which the review is actually critical of the board and the failure of the board to really press the hierarchy of the Reserve Bank, that's really interesting. There is criticism in that space. In terms of the recommendations, there's a real move towards you need to have fiscal policy, budget spending, more closely aligned with where the central bank is headed with interest rate settings. Like you don't want them pulling in opposite directions, which we've actually seen. Like famously in 2019, Phil Lowe sliced in half the cash rate while the government of the day was trying to get back to budget surplus. And so you actually had what I call was a proof of life video. There was Phil Lowe next to Josh Frydenberg saying, "Oh, we're going to spend a bit more money on some roads," saying, "Yeah, we're right on the same path." And you read the review and the bank's going, "Hold on, we're having to cut interest rates because the economy is too slow." The discussion around that and the fact that the review really wants a bit more focus in that space, I found really intriguing.
The government's already said that it will implement all the recommendations. It thinks that this is an excellent piece of work and wants to go ahead with it. How will it affect the way we fight inflation and what that means for the economy more generally?
I think the best example would be if you had these set of recommendations, where would interest rates be right now? They may be at the same level, but the Reserve Bank would have been lifting interest rates much earlier. So remember that the Reserve Bank didn't lift rates until the first week of May last year, just ahead of last year's federal election. Based on these sort of recommendations, you would have thought, oh, the bank may have actually started lifting perhaps in February or March. It may actually have the cash rate at around the same level, but we wouldn't have whacked people so heavily so quickly. There is a case maybe interest rates would have been higher as well, because if you're a central bank really focused on inflation, then that may have been the path you'd take. But on the other side, the recommendations here are saying the bank needs to also focus on full employment. So the Reserve Bank's job is stability of prices, aka keeping inflation between 2 and 3%, and full employment. We've got full employment at the moment, and there's hundreds of thousands of people getting paid, being able to pay off their increasingly expensive mortgage, thanks to where the bank has had interest rates. So that's the trade-off that's going on all the time.
Normally, with these sorts of really, really big, extensive reforms, you would expect to see a lot of political argy-bargy over it. But in this case, it seems to be a rare example of bipartisanship. The coalition has indicated it is happy to support a lot of what the review has recommended. What's in it for the coalition to be so supportive of where the government wants to go on this?
Well, the first one is they went to the election promising a review. So they would have been in a similar space as the current government is, because they recognised some things had to be done. Because the Reserve Bank hasn't had an outside review since 1980. It's the only central bank in the world that has not had someone come in and look under the carpet to see how much dust has been pushed underneath there. So that was one factor. Two, Angus Taylor the Shadow Treasurer, has been brought into the process by Jim Chalmers. So the review panel briefed Taylor quite often. In fact, Taylor got a full copy of the report just after Chalmers briefed his own cabinet about it. So there's been a fair degree of trust. And both sides agree that the Reserve Bank has to be beyond politics. It has to be independent so it can go about doing its business. And this is why we ended up with central bank independence in the first place, because you don't want interest rates determined by who's in power and where they are in the political cycle. You want that complete independence from political interference. And so I think Taylor recognises, like he had early worries, perhaps they'll change the inflation target. That's clearly not what's happened. It's really about the structure of the bank. And you can see why Taylor would go, right, as a useful opposition, we think we can do a lot of good by going down this path.
There has been some criticism from the Greens. They say it's a major party stitch-up. They go so far as to say that the major parties are trying to shield scrutiny of their own role in what has happened with the economy over the past few years. What do you think of that viewpoint? Is there much to that argument?
No. Look, the Greens, remember Nick McKim, their Shadow Treasurer, wanted to get rid of Phil Lowe because saying, look, interest rates are too high. Now, Nick McKim is not a monetary policy expert and has yet to explain how he would bring down inflation, because at the end of the day, inflation is a terrible thing, especially for low-income earners. So Nick McKim and the Greens have gone back to the 1970s, 1980s of the government wanting to control interest rates. And that's not the world that we operate in, and for good reason. So you can understand why, particularly from Chalmers' perspective, he wanted an agreement, a situation where the Liberal Party would sign off on this so he doesn't have to make any concessions inside the Senate. The interesting thing is the review actually notes we want bipartisanship on this, and we can come up with ideas to help improve the Reserve Bank if you can't get that. So the review's very politically aware of some of the far left, far right and populist arguments that are around central banks, not just in this country but around the world, and that's what they've been trying to avoid.
Finally, the million-dollar question, and it is a million-dollar question, the future of the current Reserve Bank Governor, Phil Lowe. A lot of talk around whether or not he will stay on. What do you think the signs are on that front?
I think it's too early because Chalmers really does respect Phil Lowe and thinks he's been given a tough task and has been trying to do his best. But there are, like before COVID, there were probably 250,000 people out of work who didn't need to be because the Reserve Bank had interest rates too high. You come to the point now, inflation's probably higher than it otherwise would be because of some of the central bank's actions. That's not to dismiss what government has done. I only have to look at the housing market to know how much damage governments have done in this country to housing affordability with some of their stupid policies around everything. But in this case, so Lowe's term finishes in September. You could argue, look, leave him in place until the middle of next year to bed down some of the issues. Or you go, right, Dr. Lowe, finish up in September, we'll get in a fresh face then to really put their stamp of approval and authority on the changes that are coming through.
Thanks very much for joining me today on Please Explain, Shane.
Always a pleasure to spend time with you, Stephanie.
Today's episode of Please Explain was produced by Chi Wong with help from Julia Carr-Katzel. Our executive producer is Ruby Schwartz. Please Explain is a production of The Age and the Sydney Morning Herald. If you enjoy the show and want more of our journalism, subscribe to our newspapers today. It's the best way to support what we do. Search The Age or smh.com.au/subscribe. I'm Stephanie Peatling. This is Inside Politics from Please Explain. Thanks for listening.